So, Matt Piepenburg and myself, we're back for another MAM Chat. Lots of things happening as usual in markets. And, on the one hand, we've had market euphoria because of the vaccines. On the other hand, COVID is spreading more than at any time, both in Europe and in North America. But markets, of course, ignore that, and vaccines maybe change everything according to markets. So what's your take on this? Are we going back to normal, Matt?
That's a thing that's been spread around a lot in the conversations and with my friends, and certainly in the headlines now, is this hope that a vaccine will take us back to normal. And my retort is always the same. What normal? There was nothing normal going into COVID, and it's certainly not normal coming through COVID. We all want to see COVID contained, and we all want to see a vaccine, that's for certain. But I think it's important to remind ourselves and others that looking back, and it's hard to think about the pre-COVID times, but if you look back just a year ago, where I was at the end of 2019, coming into 2020, in fact, right when Rig to Fail came out in February of 2020, just before COVID made the headlines, it's important to know that there was absolutely nothing about the pre-COVID period that was normal. And I look at the smallest indicators to the largest indicators, Egon, and it's astounding. I mean, just coming off of Christmas at the end of last year, again, pre-COVID, even things as simple as Walmart sales in the US were at all-time record lows for Christmas because the middle class or the Main Street economy was already struggling going into Christmas before COVID. Retail sales were down 40% already pre-COVID going into the end of 2019 and coming into 2020. So there was already a struggle at the Main Street level. And then things like the Cass Freight Index were already showing signs that there was less movement of goods at the ground level in the US economy or manufacturing. Remember, it's been kind of forgotten, there was a trade war raging with China in 2019, and there was a $40 trillion deficit on the Chinese books already. So that was hardly normal coming into COVID. Yield curves were inverted across the board in the US, which for the yield curve inversion has been a precursor to 7 of the last 7 recessions in the US. So that was hardly a normal sign going into COVID. And then let's not forget probably the 2 biggest symptoms that things were hardly normal going into COVID, pre-COVID, was in 2019 in September, we saw that spike in the repo markets, which was kind of downplayed and poo-pooed by the media, and even the Federal Reserve called it a glitch in the plumbing. But we're talking about a 10% daily rate hike in the repo markets, which was just proof that the Fed was losing control of the money markets and the rates. That was an astounding symptom of something bad on the way. It had nothing to do with global viruses or a pandemic. And then within a month of that repo disaster, which remind you, that was a $1 trillion quote unquote bailout loan package within a matter of weeks for the repo markets. Within a month of the repo disaster, we had quantitative easing back, although the Fed didn't call it quantitative easing. In October of 2019, we were back to printing $60 billion a month to bail out the Treasury market, the Treasury bill market. Another sign of very, very abnormal markets or very abnormal conditions. GDP going into COVID, pre-COVID, was annualizing at less than 2%. And something that's never really taught in grad school or business school was happening as well. That, we talk about recessions, corrections, depressions, but the real definition of a depression is a slowdown in the growth rate of GDP per capita, which gets a little complicated, but the per capita growth rate in GDP for the US pre-COVID was already at levels that were lower than the Great Depression in the 1930s. So again, even that kind of boring metric was hardly normal pre-COVID. Of course, the Fed's balance sheet was about 3.8 trillion then. Now it's 7.1 trillion, but we were already over our skis in QE. Oil prices certainly weren't doing well pre-COVID. Gosh knows after COVID started and transportation was shut down around the world, oil prices continued to tank. But I think most importantly, the policy making pre-COVID was just as desperate pre-COVID as it was now. It's just gone faster. The simple fact is that central banks in the US and around the world were continually printing money to buy their bonds, to keep yields and interest rates low so they can continue this debt rollover party. COVID has only made that abnormal far more abnormal. So there's no going back to anything normal. But of course, now we're talking about unlimited QE and unlimited support from central banks, from Kuroda to Powell to Lagarde in Europe. And you know what that means, Egon, it's a clear tailwind condition for precious metals. And so looking at all those Main Street and global macro indicators, nothing was normal. I'm curious what you're seeing as a continuation of the abnormal and why that's such a perfect backdrop for gold and silver, and what signals you're seeing in the gold and silver markets.
Well, Matt, thanks. Well, you know, I've always been a long-term man when it comes to investments, including gold. You know, we're, as you know, we're holding gold for clients because we want to assist them in protecting their wealth on a long-term basis. So we are not really concerned about short-term movements or manipulation in markets, because when you buy your insurance, you know, you buy it because you need the protection, and you don't buy it before the day before you need it. You hold it for a long term. Right. You know, we've been, as you know, we've been into gold for 20 years, and you know, gold was 300 when we started. And we've had lots of swings since then, but that hasn't changed anything. You know, we've gone up quickly to up to 1900, down to almost 1000, but the picture hasn't changed for us. So therefore, you know, when it comes to these short-term movements, we are not really looking at them or concerned. At the same time, you know, we're all in markets, and so are the clients, and many clients like buying, not clients, but many investors like buying when it's high and selling when it's low. But you know, we are lucky to have clients who actually buy for wealth preservation purposes, so they don't really care about the short term. But especially when an investor gets in, you know, as a new investor, then they like the timing very often. Now, so just look in the last, if you look at the short term, then you know, we've had in the last couple of weeks, so we had gold moving up $100 in 5 days. And then came the news on the vaccine. Then came the news on the Biden supposed win, which is not clear yet. And then gold in 5 hours went down $500. Sorry, $1,000. So up $1,000 in 5 days, down $100.
$100.
Sorry. Yeah, up $100 in 5 days, and then down $100 in 5 hours.
Right.
And you know, but then you look at where was the movement? There was, you know, there was nothing whatsoever in the physical market. You know, we didn't see any movement whatsoever. Our investors, you know, or didn't buy or sell any gold in that period, and the refiners saw basically no physical movement in the last few weeks. Actually, in the last 5-6 weeks, they've seen very little physical movement. So this market, so these moves, so gold market is actually quite quiet now, but these moves, they all happen in the futures market, as we both know, and it's got no relation to the real market whatsoever. And so therefore, I think we could ignore these moves. Gold is now in a phase where, you know, you have to remember, gold went up $300 this year, 20%, 320% since the beginning of the year. And gold still, you know, gold is up 20%. And where's the stock market? It's up 2%. The stock market, in spite of all the euphoria, it came from a low level in March, but it's only up 2%. So therefore, gold is still outperforming all other markets, as it has been for all of this century, with fluctuations in between. So that's what we are seeing. You know, and right now, because we've had such a big move early in the year into gold, into physical gold. And we saw a very big inflow in clients coming in buying gold. So now it's been quiet for a while. But you know, if I look at now short term, the only way to look at any market is technical, of course. Fundamentally, we know that the institution or the central banks around the world are going to continue to support the gold market by expanding liquidity and printing money continues. We know, and that's going to accelerate next year. So we therefore see a continued demand for gold and a debasement of currencies, and therefore increase in the gold price. And technically, the gold price actually looks like it's finishing a move now. It could take another 2-3 weeks. We could see slightly lower down into the 1800s. That's not a forecast, but that's a possibility. And then thereafter, we see the next move is going to be a strong, very strong move in gold, very strong. And that maybe start in December, maybe start in January. It doesn't matter. Long term, gold is totally supported. And that's what we've seen this year. It's just a short pause now. It's a great time for investors to buy, not to talk about silver, of course, which, you know, I talked about in my, also in my latest article. You know, silver on an inflation adjusted basis should be, you know, should be over $900 compared to the 800, the 1980 $50 price. If you inflation adjust that, you're now up to $900. So you know, the potential is enormous, but gold is therefore, and silver and precious metals, therefore wealth protection, obviously, wealth enhancement is secondary, but that's going to happen too if you own precious metals. So that's what's happening in the metals market. I mean, the fundamentals are supporting it totally. We're going to have a very difficult year, as you said, in the economy. You know, the coronavirus is not actually the reason for the problems in the economy, and those problems will accelerate next year. So therefore, I'm very confident that's going to be an excellent year for precious metals and a very important year for wealth preservation, Matt.
Absolutely.
So maybe we try should finish today at this point.
We'll keep it short. I think the point's well made. There was nothing normal going into this. There's nothing normal coming out of it, but the conditions are fantastic for precious metals, and it's not a price game. It is a preservation game, and we've been talking about this consistently.
Yeah, absolutely. All right. Well, thank you very much, Matt, and thank you for listening. And we'll be back in a week's time.
Sounds good, Egon.
Thanks.
Bye-bye.
Yeah. Thanks. Bye.